Micro-cap stocks. For some, that might sound like venturing into the wild west of the market.
Yeah, a place maybe riddled with risk, companies you've likely never heard of.
Exactly. And while it's true that this corner of the investment world can feel, well, less familiar, it's also where diligent researchers might find some really compelling stories.
And potentially significant returns, if you know where and how to look.
Welcome to the deep dive. Today, we're tackling this fascinating area using the source you shared, the micro-cap investor.
Right. Our mission, so to speak, is to really dissect the world of these smaller public companies.
Pulling out those essential strategies for not just finding opportunities, but, truly understanding their unique DNA.
Precisely. Think of it as equipping yourself with the tools to potentially uncover that information advantage. It's a segment that often flies under the radar.
hmm So we'll explore how to rigorously evaluate these smaller businesses. They often operate differently than the big guys.
Absolutely. And we'll consider how they might strategically fit into a well-diversified investment approach. This isn't about wild speculation.
No, it's about informed discovery. Okay, so let's start with the basics. Lay some groundwork. What exactly is a microcap?
Good starting point. Our source uses market capitalization, the total market value of all the outstanding shares.
Okay, and we generally agree what, over $5 billion is large cap territory?
Yeah, that's the usual benchmark. For context, think about the S&P 500 index. Back in mid-2004, its smallest company was around $414 million market cap.
So microcaps are significantly smaller than that.
Definitely smaller. And what's interesting is the distinction our source makes with penny stocks.
Right, people hear microcap and immediately think, super low share price, maybe under $1, trading on the OTC bulletin board or pink sheets.
And they associate that with low quality, high risk. Which, look, can be true for many of those very small, low-price stocks. They can be highly speculative.
But that's not the whole story for microcaps.
Not at all. It's vital to grasp that microcaps, despite their smaller market value, can absolutely be well-managed, high-caliber businesses. The share price alone doesn't tell you everything.
Right, got to dig deeper than the price tag. And speaking of digging deeper, this idea of an information advantage comes up in the source.
Yes, it's a key concept.
Now, for many of us, the financial world seems incredibly efficient, doesn't it? Like all information is just instantly baked into stock prices.
That's the common perception, yeah. Which brings us to the efficient market theory, EMT.
Okay, can you unpack the core ideas of EMT for us?
Sure. At its heart, EMT makes a few key assumptions. First, a large pool of rational, profit-seeking investors, all analyzing the same public info.
Okay, makes sense.
Second, new information about stocks arrives randomly. And third, these investors quickly adjust prices to reflect that new info's impact.
Quickly, but maybe not perfectly instantly.
Exactly. Even proponents admit adjustments aren't always perfect in the very, very short term.
All right, so if that's the picture of this well-oiled machine,
Right.
where do microcaps kind of break the mold? Where do they deviate?
That's the crucial question. Our source argues they often do deviate from this perfect efficiency.
How so?
Well, think practically. These smaller companies get way less attention from Wall Street analysts, from big institutional investors.
Right, you don't see dozens of analysts covering some tiny company.
Precisely. There was a study by Riley, mentioned in the source, suggesting mid-tier firms, which includes a lot of microcaps, often don't have information fully reflected in their prices like the market giants.
Ah, okay, so less coverage, less institutional money chasing them. That leaves gaps.
It could, yes. Gaps for diligent individual investors to potentially uncover opportunities the wider market hasn't fully appreciated yet.
Because if a small company has, say, only one or two analysts, or maybe none.
Compared to the dozens scrutinizing,
Yeah.
like a Microsoft. Yeah. A dedicated investor might find public information that just hasn't been completely priced in.
The speed and intensity of analysis for large caps is just so much higher.
Absolutely. Information gets disseminated and acted upon much, much faster there.
That makes a lot of sense. It reminds me of that concept from venture capital, the principal agent problem.
Yes. Where investors actively gather information to screen and then monitor their investments, our source draws a parallel there.
How does that apply here?
Well, just like VCs vet startups, in the microcap world, you might see a situation where general negative sentiment keeps a stock price down, even if positive changes are happening under the surface.
Or maybe like tracking milestones in a startup.
Exactly. Closely monitoring a microcap's progress, hitting targets, new contracts, whatever, can reveal emerging opportunities that the market hasn't woken up to yet.
And the source also brings up shareholder activism in microcaps, another way to bridge that gap.
Yeah, aligning management and shareholder interests. Similar to incentives you see in VC deals.
So activism can be a catalyst for change, like correcting misalignments.
It can be. A significant shareholder, or maybe a group, builds a stake and then uses that leverage, financial, sometimes legal pressure, to push management towards changes they think will boost shareholder value.
Interesting. So these inefficiencies aren't necessarily bad news for the investor willing to put in the work.
That's the argument. They can actually be an advantage.
Okay, let's step back a bit.
Hmm.
How do microcaps behave as like an asset class within a broader portfolio?
Right, the bigger picture. Historically, small cap stocks, which include microcaps, have tended to outperform large caps over the long haul.
But there's a catch, right?
Absolutely. Crucial catch. That potential for higher returns comes with higher risk, more volatility, bigger price swings.
The source mentioned a table, Table 3.1, showing risk-return data.
Yes, covering 1974 to 1993. It clearly shows microcaps had higher average returns and higher standard deviation. That's a measure of volatility compared to larger caps.
So more potential upside, but definitely need the stomach for the ride.
You do. And our source also draws this intriguing parallel between microcaps and private equity.
How so? What's the connection?
It's mainly about information flow and liquidity. Both tend to have less readily available public info compared to large caps.
Okay, less transparency.
And lower liquidity, meaning it can be harder to buy or sell shares quickly without moving the price significantly. Private equity info is often tightly held, right? Microcaps can feel a bit like that sometimes, just less followed.
Gotcha. And there's also a link mentioned between public microcap valuations and the private equity VC IPO market.
Precisely. The health and valuation levels in the public, small, and microcap market. That sends a big signal to PE and VC firms.
About whether it's a good time to take their portfolio companies public.
Exactly. If the public market is receptive, assigns decent valuations to new, smaller IPOs, then VCs are more likely to fund companies with that IPO exit strategy in mind.
Okay, foundation built. We know what they are, the potential info edge, how they fit in. Now, the million-dollar question. How do we actually identify promising opportunities? How do we use that potential advantage?
Right, this is where the real work begins. And our source really hammers this home. When it comes to microcaps, management quality is huge.
Even more important than in large companies.
Arguably, yes. Because these are smaller, often less diversified outfits. The leadership skill, their vision, their integrity, it has a disproportionately large impact on success or failure.
Makes sense. Smaller ship, the captain's influence is more direct. And one key indicator the source flags is insider buying.
Yes, huge signal potentially. When the company's own execs, directors, key insiders are buying shares on the open market.
With their own money.
Exactly. That can be a strong leading indicator. I mean, who knows the business better, right? Its health, its prospects.
And they have to disclose these trades.
They do. Material insiders have to file with the SEC.
So it's not just if they're buying, but how they're buying. The source mentions focusing on open market trades and looking for patterns.
Precisely. Open market buys are generally the most telling signal. Suggests a real belief the stock's undervalued or the future looks bright.
And not just one person buying once.
Right. Look for clusters of buying. Multiple insiders buying over a sustained period, the source suggests maybe 9 months to a year. That collective action can be a powerful sign.
Okay, so watch the insiders. But beyond that, how do you assess the quality of the management team itself? What do you look for in their backgrounds?
Several key areas. Look at their resumes, obviously. Are there patterns? Have they worked together successfully before? Relevant education or industry expertise?
Track record matters too, presumably.
Hugely. A CEO with a history of growing and selling companies successfully. That's relevant experience. Investment banking background can be valuable too for M&A or raising capital. Seeing those patterns boosts confidence.
And it's not just individuals, but how the company is structured, decision-making processes.
Absolutely. Understanding the org chart, how decisions get made, is it centralized, collaborative? How does information flow? That gives insight into operational efficiency.
Like for a retail company, who decides where to open new stores?
Exactly. Knowing who holds that authority and expertise is critical.
The source also mentions assessing management style and long-term planning.
Yeah, is it top-down or more team-oriented? That hints at culture, talent retention, and how rigorous is their strategic planning, internal reporting, feedback loops that tells you about their capacity for sustained growth.
What about management changes? That seems like a big deal for a small company.
It often is a significant leading indicator, but you need to dig into why the change happened.
Right. New management might signal a turnaround.
It could, but the positive impact often takes years to show up. New teams might initially, clean house financially, set a new baseline. Shifting strategy and culture takes time.
And finally, the source suggests looking at how they develop their own people, promoting from within.
Exactly. A company investing in its workforce with clear advancement paths. That suggests a healthier culture, better talent attraction, stronger long-term foundation.
So evaluating microcaps is clearly about more than just numbers. It's people, processes, culture. Now, where do you actually find all this info? These aren't front-page news stories.
Critical question. They might not get constant media glare, but there are resources. Our source gives a good checklist.
Let's run through some key ones. Obviously, the company itself. But federal regulatory filings are crucial, you said.
Absolutely paramount.
Yeah.
SEC filings are a gold mine. But don't stop there.
What else? Competitors?
Yeah, look at competitors, their sales. Marketing can be insightful. Talk to customers, suppliers if you can, industry trade associations.
Analysts. Though coverage is limited, you mentioned.
Right, limited, but check anyway. Newspapers, trade publications, internet searches, even legal documents can yield clues.
And you really emphasize those SEC filings. The 10K annual report.
Treasure trove, business description, financials, properties, subsidiaries, legal stuff, major shareholders, exec bios, indemnification. It's all in there.
Plus the quarterly 10Q and the 8K for current events.
Indispensable for staying up to date on significant happenings.
But a warning from the source. Reporting isn't uniform, especially for OTC bulletin board or pink sheet stocks.
Very important distinction. Major exchanges like NYSE or NASDAQ have minimum standards, stricter reporting. OTCBB and pink sheets, often much lower disclosure, less scrutiny. Buyer beware there.
Okay, assess management, found info sources. Now the numbers. What financial tools are good starting points for screening microcaps?
The source highlights a basic but powerful holy trinity: price to book value, price to free cash flow, and price to earnings.
Price to book and price to free cash flow look for low values. Why?
Low price to book might mean the market isn't fully recognizing the company's underlying asset value. Low price to free cash flow is attractive because cash flow gives flexibility.
Flexibility to do what?
Reinvest in growth, pay down debt, make acquisitions, return capital via dividends or buybacks. That financial cushion is a big plus, especially for smaller companies.
And the PE ratio, price to earnings. Why is a low one potentially good here?
Interestingly, the source values a low trailing PE for microcaps. Because analyst coverage is scarce, reliable forward earnings estimates are hard to find.
Ah, so look at what they actually did earn.
Exactly. A low multiple of past earnings might signal improving trends or unrecognized value that the market hasn't caught on to yet.
To make this concrete, the source uses case studies. Let's touch on a few. Guerin Company, GAN. Classic low PE story.
Yeah, Guerin's a great example. Consistently profitable, solid growth, but traded at a modest PE for ages. Then, boom, acquired by Berkshire Hathaway.
Warren Buffett saw the value.
It underscores how an undervalued, solid microcap can eventually get recognized. The key is the consistent profitability at a reasonable valuation.
Then there's Suiza Foods that highlights industry consolidation.
Right. Suiza had this aggressive strategy to consolidate the fragmented dairy industry via acquisitions. Management had relevant banking and dairy experience.
And their actions created other opportunities.
Yeah, they bought Morningstar Group, invested in Horizon Organic. It shows how understanding industry trends and management strategy can uncover layers of opportunity.
And Horizon Organic, HCOW itself. An interesting story of post-IPO undervaluation.
Exactly. Its price dropped after the IPO, but then it showed those classic signs. Low price to book, low price to cash flow, significant shareholder buying.
Making it attractive for Suiza to buy later shows patience and fundamental analysis can pay off.
Definitely. Then you have cases like Michael Foods illustrating the complexities of going private deals with PE firms.
And Gale Company, where management resisted a sale. Different dynamic.
Right. Michael Foods shows the negotiations, competing interests. Gale highlights potential conflicts of interest management with little equity, might resist a sale, good for shareholders.
And Paz and Company, high volatility in biotech.
Prime example. Huge swings based on FDA news, shows the risks and potential rewards in that sector. Also, insiders sold after good news valuation still matters.
Lastly, the source mentions PIPE's private investments in public equities, another research area.
Yes. Basically, private sales of public stock to institutions conditioned on future registration, often seen as smart money deals.
And the terms can be revealing.
Exactly. The PTEC Holdings PIPE example. The conversion premium indicated institutional investors' confidence in future stock appreciation. Higher premium often means more confidence.
Now, for listeners maybe daunted by researching individual stocks, the source covers microcap funds too. Key considerations there.
If you go the fund route, mutual fund or ETF, definitely compare its performance. Benchmark against indices like the Wilshire Microcap Index and other similar funds.
Over what time frame?
At least 3, ideally 5 years or more. And really understand the fund's objective, its strategy, the risks which are higher for microcaps.
Expense ratios are probably higher too.
Generally, yes. Researching these stocks is labor-intensive. Also look at the management structure, single manager, team. And be aware, very large fund size can actually hinder returns in this less liquid market.
So read the prospectus, the statement of additional information.
Absolutely. Get the full picture before investing.
Okay, bringing this all together, what's the single most important takeaway from our deep dive into the microcap investor?
I'd say the central message is this. Yes, microcaps carry higher risk and volatility than larger companies. That's undeniable.
Is that it?
But for investors willing to do the homework, the thorough due diligence, there's real potential to uncover significant opportunities and possibly achieve above-average returns.
Because of those information inefficiencies we talked about.
Exactly. Those inefficiencies can become a major advantage for the informed, patient investor.
And we really encourage you, the listener, to dig into those resources, especially SEC filings, and think about how these strategies fit your own goals, your risk tolerance, your portfolio.
Which leaves us with a final thought for you. In a world so focused on the giants, the big, heavily analyzed companies, could the real hidden gems, the companies poised for significant growth, actually be hiding in plain sight within the microcap universe?
Just waiting for those willing to take that closer, more informed look.
Something to consider.